by the way, I'm not saying that nobody has felt pain, but the relative lack of pain that we've felt in the economy has amazed me. And in the near term, I would suggest that I'm bullish on the broad economy and equities, both because we've been able to withstand the pain, but also because there are literally trillions of dollars sitting on the sidelines. Investors are really, really, really cashed up. Before I come away as too bullish, however, I would suggest to your listeners that the effects of interest rate rises often lag, which is to say, as an example, the doubling of the 30-year mortgage rate has resulted in a slowdown in single-family residential sales. But we haven't seen wholesale price declines because people haven't been willing to lower the ask prices. What we've seen is a sort of a hiatus in transactions. And my guess is that as the impact of higher interest rates gets felt through the economy, that the reaction of the economy, that is the negative reaction of the economy, will start to pick up. I also would caution investors to understand that increasing interest rates are very bad for the long bond market and can be bad for the equities markets too. Bad in the sense that companies' costs of capital go up at the same time that the capitalized value of distributions, that is the competitiveness of dividends relative to other savings products, declines. I am amazed really at the resilience of the U.S. economy, but I remain very, very cautious in the face of higher interest rates. Inflation is slowing, particularly if you do as they do, which is to exclude food and fuel. One would presume that the Council of Economic Advisors neither drives, nor eats. But it's important to remember that real rates are negative. If you look, Daniela, as you and I have done for more than a decade at the U.S. 10-year Treasury,
Yep.
They propose to pay you 4% in a currency that they acknowledge is depreciating in terms of purchasing power by 7%, which is to say the real rate still penalizes savers as to 300 basis points a year.
Yep.
If they are able to address that, which I don't think they'll be able to, without a really truly meaningful impact on the economy, then things change. And if we begin to see a lagging effect of interest rates in equities markets, but also in general economic activity, I suspect that the political pressure on the Fed to pivot will be very strong. I think we went through 40 years of benign economic climate, 40 years of declining real interest rates, 40 years of the benefits of demographics. And I need to say that with the exception of benefits that we will continue to enjoy from better technology and more inclusion in the workforce, I think those benign times are past us. Peace was breaking out around the world for 40 years. There was an inclusion of more people in the workforce. And in particular, we had 40 years of declining interest rates, both real and nominal interest rates. That party's over, I think, for a while. The consequence of that is that we need to adjust ourselves to a new normal. And 2022 might be a preview of coming attractions. I would note, too, that the decline that we had was a long, slow, grinding decline through many markets, but not the sort of sharp break that we experienced, as an example, in 2008. While what you say is true with regards to the number of days that the S&P declined, the fact that the S&P didn't decline by more in the face of a doubling of interest rates and a doubling in the yield on competing products, I think really is testimony to people's belief in equities. I'm not sure that belief is well founded, Daniela, but I think what we saw in 2022 is something that we're going to need to become accustomed to. I know that the U.S. dollar is the most liquid and also the most transparent market in the world. It's a freely convertible currency. I think that the United States government is doing its very best to wreck the dollar by weaponizing it, by extraterritorial imposition of U.S. law and value. In other words, we are driving China, we are driving India, we are driving Saudi Arabia out of the dollar to the best that we can. But the dollar as an instrument is probably so strong that it will defeat the government's efforts to wreck it. It's amazing how ironic that sounds. I know from my own experience with very large Asian pension fund investors that although they don't trust us, and although they don't particularly like the value proposition around the U.S. Treasury, they don't believe that they have any alternatives with regards to the depth and liquidity and transparency in the market, which is to say, as little as they trust us more than they trust the other superpowers and trust us more than they trust each other. I think the political class in the United States doesn't know and doesn't care very much about a free economy. They know and care a lot about politics and power. And trying to enforce U.S. foreign policy goals often means debasing the trust that the rest of the world has in the U.S. as a consequence of trying to export U.S. values and laws in an extraterritorial sense. To the extent that we want to fight China, rather than trying to outcompete them in the economy, we try to hobble them by restricting their access to our currency. That in and of itself debases the trust that China might have, as an example, in the U.S. as a global economic arbiter. I think if the Fed is forced to pivot, which is to say, if rather than continuing a period of higher interest rates, they are forced because of deterioration in the economy, slowing durable goods sales, imploding real estate prices, a real equity bear market, and particularly in the face of very broad disintermediation of long-term bond holdings, then I think you'll see gold really, truly go off to the races. The last thing that I mentioned, Daniela, I'd like your listeners to pay real attention to. Rising interest rates murder the capitalized value of long bonds. And the institutional investors around the world, but particularly the pension funds, the profit-sharing plans, the university endowments, have portfolios that are loaded with long bonds. We saw what happened very briefly in the British gilt market when the capitalized value of the long bond declines and the portfolio values of these very large investors decline to the extent that in order to meet the actuarial assumptions, they have to increase contributions to the pension funds. And of course, they don't have the money to do that. The great, I think, sort of unidentified bomb in the economy is the undercapitalization of pension funds in the long term to meet their obligation, and their overwhelming reliance on long bonds at artificially low interest rates. The twin perils for them are the decline in the capitalized value of those bonds in the face of rising interest rates and the negative real interest rates that they're getting. Yes, they're getting 400 basis points, but they're getting it in an instrument or in a currency where their real purchasing power is declining by 300 basis points a year. If you reduce the purchasing power of a pension plan by 200 or 300 points a year by 20 or 30 years, what you've done is guaranteed poverty for the beneficiaries of that pension plan in their old age. And I think that we have a political conundrum that we have to face 5 years from now or 6 years from now with the chronic underfunding of these pension funds, with our inability to maintain the living standards that the beneficiaries have come to expect that they will enjoy.